Management Act, but it is administered by KRA through its Customs and Border Control Department. So the customs duty is levied on goods imported into Kenya, with the core objective being revenue collection for the government and the protection of domestic industries. So the amount of customs payable is determined by several factors. The amount of customs paid is determined by several factors. Payment of customs duty, the amount is determined by several factors, one being the customs value. The customs value. This is generally based on the price paid or payable for the imported goods, including the cost of the goods, insurance, and also freight. So the value of the goods determines the customs duty or taxes to be paid. Then we have classification of goods. Classification of goods. Goods are classified using the harmonized system, what we call HS. Goods are classified based on using the harmonized goods code. Using the harmonized goods code, the HS code. Classification is done using the harmonized goods code. Harmonized goods code system, which is an internationally standardized system for classifying traded products. And each HS code has a corresponding duty rate assigned under the East African Community Customs Management Act. So the HS code can also determine the amount of customs duty to pay. Classification of goods. Then we have the East Africa Community external tariff. 3. East Africa Community external tariff can also determine the amount of customs to pay. Kenya, we know candidates, is an East African Community member state, and the East Africa Community external tariff applies to Kenya. So the Community external tariff currently operates on bonded structure with rates typically at 0%, at 25%, and 10%. 0%, 10%, and 25%. The external tariff. Then the fourth factor is sensitivity. Sensitivity, or let me just say sensitive. Let me say sensitive items. Let me be specific. Sensitive items. Now, candidates, we are highlighting factors. The amount of customs duty payable is determined by several factors. One of them is sensitive items. There are certain goods that are deemed sensitive for economic or social reasons that attract higher duty rates, which can exceed the standard 25% and may even go up to 35% or even higher for specific products as listed in the East African Community External Tariff, second schedule. So Kenya has also been granted stay in application of certain CET rates for specific products to protect local industries or even manage supply. So these are four factors that determine duty payable. One is customs value. Number two, the harmonized system code. Then there is a East African Community External Tariff. Number four, sensitive item. These are key factors that will determine the amount of customs duty payable to the Kenya Revenue Authority. So that's the end of the lesson, candidates. And in closing the lesson, it's important to appreciate that first of all, under imposition of customs duty, the imposition of customs duty is primarily governed by the East Africa Community Customs Management Act and administered by Kenya Revenue Authority through its Customs and Border Control Department. And the process of imposing and collecting customs duty in Kenya involves the electronic submission of import declaration by clearing agents to the Kenya Revenue Authority. It is done electronically. Just go to the KRA iTax portal and the integrated customs management system. You go to the integrated customs management system and do the application. You provide the supporting necessary documents such as commercial invoices, the bills of landing or airway bills, the parking lease, and relevant licenses and permits have to be submitted as supporting documents. And then the KRA's Customs and Border Control Department, we said, is responsible for processing the declarations. It is responsible for verifying the goods, for assessing the applicable duties and taxes based on the customs value and classification, and also facilitating the payment and eventual release of cargo. That is the role of Customs Border Control, through which is a body or department under KRA. It is responsible, number one, for processing the declarations. Number two, it is responsible for verifying the goods. Number three, this department is responsible for assessing the applicable duties and taxes based on the customs value and classification. And also number four, it facilitates the payment and the eventual release of the cargo. You understand? And that is all, candidates, for today's lesson on imposition of customs duty. If you have any question, feel free to ask the questions and we will answer all questions. Bye-bye.
Welcome to Manifested e-learning platform. Today we talk about digital service tax. So what is digital service tax? And what is the inception of digital service tax? So we need to say that the Finance Act, the Finance Act 2019, the Finance Act 2019 amended the Income Tax Act, amended what you call the Income Tax Act to include incomes from, amended the income tax to include incomes from to include taxation of income accruing. When you talk about accruing, basically accruing from digital, we say from digital marketplace. So if you say that the inception, that is 2019 Finance Act, basically was amended to include income tax to include taxation of income accruing from a digital marketplace, from what we call a digital marketplace. So the Finance Act of 2020, we say that the Finance Act of 2020 introduced that these incomes that basically accrue from the digital place introduced what we call 1.5%, introduced what we call 1.5% on incomes, basically on incomes from services accrued, we say from the services accrued or derived from the digital marketplace. So introduce a 1.5 on incomes from services accrued or derived from the digital marketplace. That was basically the rate of digital tax. And say tax applicable on gross tax, the tax was applicable. The tax was applicable. We say applicable on the gross. The tax was basically applicable on the gross, what you call the gross transaction value, gross transaction value. And when you talk about the gross transaction values, that is transaction value without deducting the expenditure, was applicable on the gross transaction value of service, of the services, we say provided, of the services provided, provided and due, and provided and due at the time of payment, at the time of payment, at the time of payment. So the point is, when you talk about this digital taxes, the rate on the Finance Act of 2020 was 1.5 on the gross value, what you call 1.5 on the gross value. The responsibility, we say that the responsibility, what is the purpose of that? The responsibility to account, we say account for, was basically to account for, tax, account for tax on owners, was to basically account for tax on owners of digital marketplace, owners of digital marketplace, or agents, we say agents appointed, or the agents, or an agent appointed, or an agent appointed by the commissioner, or the agent basically appointed by the commissioner, was to responsibility to account for tax on owners of the digital marketplace or agent that is basically appointed by the commissioner, or the agent that is appointed by the commissioner. But very important, we know that the DST, and you say DST, that is the digital service tax, will be collected and remitted. We say you'll basically be collected and remitted by agents. We say appointed, by agents basically appointed, by the commissioner, of domestic tax, remitted by the agents or appointed by the commissioner. Type of transactions where DST, types of transactions where we say DST, the digital service tax, is applicable. Type of transaction where DST, digital service tax, is applicable. So when you say DST, that is basically digital service applicable. One is downloadable digital content. One you say downloadable digital, we call it digital content. Downloadable digital content, that is where DST is applicable. We have streaming of digital content, streaming of digital content, streaming of digital content where it's applicable. We also have subscription-based media, subscription-based media, subscription-based media, another area where it's applicable. We also have online sales of ticket, online sales of tickets, online sales of the tickets, online sales of the ticket. Data management, what they call data management, using what they call the data management using electronic means, using what we call electronic means, as another area where DST, digital service tax, is applicable. Data management using electronic means. We can also talk about e-learning, learning, and we can talk about what we call search engines related service. Search engines related service. Search engines related service. So these are the areas where we have DST being applicable, where we have DST being applicable, where we have DST, that is digital service tax, applicable. I want us to talk about digital asset tax. Digital asset tax. We talk about what we call the digital asset tax. So what is what we call digital asset tax? We say anything of value, that is basically anything of value, and that is not tangible, and cryptocurrency, tokens, that is not tangible, and cryptocurrencies, token codes, number held in digital forms. So we say digital is anything of value, is anything of value. Basically, we say anything is anything of value that is not tangible. That is not tangible. And cryptocurrencies, and what we call cryptocurrencies, and cryptocurrencies. We have token codes. We have the token codes. Token code, numbers held in digital, numbers held in digital, numbers that are held in what we call held in digital form, digital form, numbers that are held in digital form. We talk about numbers that are held in digital form through cytographic means, through cytographic, we call it through cytographic means. Numbers that are held through digital form through cytographic means, or otherwise whatever is called, provided altogether. So digital asset means digital asset, what do you call the digital assets. We say includes. So the digital asset basically includes what you call photos, manuscripts. Examples of digital asset, manuscripts. We have documents. We have the documents, and we can name a few. Security token, and the others that we've mentioned, token called security tokens, and we have what you call crypto assets. We have the crypto assets as a form of digital asset, crypto asset. We can also have tokenized assets, what do you call the tokenized assets, But an emphasis here together, when you talk about digital, is anything of value that is not tangible, and cryptocurrencies, token codes, numbers held in digital form through cytographic means. And you say that examples of the digital asset basically includes photos, manuscripts, documents, security tokens, and we have cyto asset and tokenized assets as the types of digital asset. So we need to understand that the Finance Act as an NB, we need us to understand that the Finance Act, we need to understand that basically the Finance Act has introduced digital asset tax payable, as basically the Finance Act has basically introduced the digital tax payable, digital asset tax payable by person on income, derived from transfer or exchange of digital asset, or exchange of digital asset, or exchange of what you call digital asset. So for as introduced, Finance has introduced digital asset, what you call the digital asset. Finance has basically introduced what you call the digital asset, tax payable, asset tax payable. We say payable, digital asset tax payable. So we are basically saying that the Finance Act has introduced digital, has basically introduced what you call digital asset tax payable, payable by persons, payable by what you call persons, payable by persons on incomes, we say derived from the transfer, derived from what you call the transfer, or exchange, or what you call the exchange of what you call the digital asset. And we know the digital asset include photos, manuscripts, documents, security tokens, transfer or exchange of digital assets at the rate. We say at the rate of what you call 3%. At the rate of 3% of the transfer, or what you call the exchange value. Exchange of the transfer, or what you call the exchange value. So we say that the tax, the 3%, the tax shall be. We say that the tax basically shall be payable to, we know that the tax shall be payable to the commissioner, So this tax is payable to the commissioner. We say the commissioner by the owner of the platform, by the owner of the platform. So this tax is essentially payable to the commissioner by the owner of the platform, or the person, we call it the person facilitating, the person that is basically facilitating the transfer, facilitating the exchange, what you call exchange, or what you call transfer of digital asset. So the person that is the owner of the platform, or the person that is basically facilitating the transfer of the digital asset, this should be done within 5 working, within a period, within a period of 5 working. We call it within a period of 5 working days. When should it be facilitated to the commissioner? Within a period of 5 working days from the date, we say from the date. We call it from the date. We call it from the date that the deduction was made. That the deduction, from the date that the deduction was made. So that amount needs to be remitted to the commissioner, that is the KRA, within 5 working days from the date in which the deduction was made by the platform or the person facilitating the exchange. So then we have what we call digital. We call it digital monetization, content monetization, digital content monetization. How do you make money through those? Monetization, how do you basically make money from those digital content monetization? So we know that digital, we need to understand that digital content monetization, digital content monetization, what we call the digital content monetization, will be subject, will be subject to WHT. When you talk about WHT, that is withholding tax, will be subjected to a withholding tax of 5%, 5% that is for resident, and 20%, and you say 20% for the non-resident, and 20% for the non-resident. So we're saying that when you talk about digital content monetization, we say that this will be subjected to a withholding tax of 5%, that is for the resident, and we have 20% that is for the non-resident, without a permanent establishment, without what we call a permanent, without a permanent establishment in Kenya, without a permanent establishment in Kenya, without what we call a permanent establishment in Kenya, without a permanent establishment in Kenya. So what is digital content monetization? When you talk about digital content monetization, refers to offering or payment, entertainment, social, artistics or education, or any other electronic through the medium or channel. So when you talk about digital content monetization, we know that is offering of payment, offering for payment, that is entertainment, social, we talk about literal or artistic through the electronic. So we can note it down that digital content monetization, just a recap of what we were saying when you talked about digital content monetization. We basically say that offering for payment, entertainment, you can offer entertainment for payment, social, literal or artistic or education material through what you call electronic media or channel. So say digital content monetization refers to offering for payment, entertainment, offering for payment, that is entertainment, offering for payment, that is entertainment, offering for payment, that is entertainment, social, we have the literal, artistics, or we can say, or what do you offer? Other materials, we say other materials, electronically, we call it electronically through any media, through what we call any medium, any media, any medium, any medium or channel, or channel. So that is what we call digital content monetization. You know, when you offer entertainment through electronic media for payments, you know, that is digital content monetization, like the musician. And then we can talk about in the following forms. In what forms? In the following forms. What are these forms that we talk about? You know, what are these forms that we offer them for payment? We know that fees earned from crowdfunding. You know, what you call fees and from what you call crowdfunding. From what you call the crowdfunding. That is one of the forms, fees earned from crowdfunding. Licensing of content. Licensing of content. Licensing of content. Or what you call the photographs, you know. Photographs, licensing of content, including what you call the photographs, music. When you license them for payment, that is one of the form. Payment to content creator, payment to content creator, payment to content creator for promoting. We say for promoting what you call a brand. Payment to content creator for promoting what you call a brand. A payment that is done to the content creator for promoting a brand. We can also talk about advertisements. We have what you call number 4, advertisements. What do you call advertisements? Advertisements on websites, on what you call websites, advertisements that are basically made on website, and social media platforms, and social media platform, and social media platform. What you call the social media platform, by partnering, by what you call partnering, you know, coming into partnership, coming together with other people, with brands, by partnering with brands, by coming together with brands, including endorsements. And to say including endorsements. So what are the forms of what you call entertainment, social, literal, artistic? They come in the form of, you know, advertisement on websites and social media where you partner with the brand, or payment to a content creator for promoting a brand. And we can also talk about what you call subscription, payment to access what you call subscription payment, what you call the subscription payment to access. We say to access what you call content, to access what you call a content of a content creator, to access a content of a content creator, including the membership, you know, where we have platforms where these content creators have exclusive membership program, including what you call exclusive membership programs, including exclusive membership programs, including what you call exclusive membership program. But lastly, as we discuss, we can talk about what you call affiliate marketing. You know, very common, you know, affiliate marketing, where influencers paid every time they fan likes a product. You know, affiliate marketing, where an influencer is paid that every time a fan clicks the product they are promoting. That is also a form of monetization, you know, when you talk about entertainment. Then we go to challenges, you know, a very common question you can be asked, challenges. We talk about challenges facing implementation of the digital taxes. Challenges, what we call challenges faced by government. Challenges faced by government, faced by the government, in taxing, what we call in taxing, digital, we call it the digital, in taxing the digital economy. What are some of the challenges that basically government face in their quest to tax what we call the digital economy? Challenges that the government basically faces in taxing what we call the digital economy. One of the issues is what we call enforcement. What we call enforcement. How do we enforce the digital platform? And that is tax authorities are faced with challenges of enforcing compliance in taxation, especially on digital platform, enforcing what we call compliance on in taxation of the digital platform because of borderless nature of digital transaction. Why? Enforcement, difficult because of what we call borderless enforcement. Difficult because of the borderless, what we call the borderless enforcement. Difficult because of what we call the borderless digital borderless nature of what we call digital transaction. Borderless nature of the digital enforcement basically is difficult because of what we call the borderless nature of getting the borders of where it lies, borderless nature of the digital transaction. We also have what we call identification of the tax base. Number 2 is what we call identification of what we call the tax base. Identification of what we call the tax base. For example, intangible nature of digital products. Intangible nature of digital intangible nature of the digital products and services. Intangible nature of the digital products and services makes it difficult to quantify, makes it what they call difficult to quantify. Makes it very difficult to quantify. Make it difficult to quantify the value, what they call the value of the tax base. Makes it very difficult to quantify the value of the tax base. Makes it very difficult to quantify the value of what we call the tax base. And say lack of location. Lack of what we call location. Lack of location. What we call the lack of location. And when you talk about lack of location, digital economy present challenge in difficult identifying. Challenges in identifying. We say in identifying. The challenges basically, in identifying the locality of business, identifying the locality of business, where is the business located, locality of business for the SAM, or business for site visit, by revenue authority. Because platform, we can have even foreign companies on those platforms, So identifying location by revenue authority stroke what you call officer authorities stroke office or officers stroke officers. Then we call what we call profit shifting. Profit shifting. Lastly, we have what we call profit shifting. Lastly, we have what we call the profit shifting. So digital transactions are usually associated with the international organization who can use complicated transaction, to shift profit to country with low tax rates, to shift the taxes. You know, when you talk about the digital platform, we know that digital platform is basically composed with international organization. And this international organization, basically, they can shift the taxes to countries with low tax rate. That is what we call the profit shifting. And lastly, we have what we call tax jurisdiction. What we call the tax jurisdiction. What we call the tax jurisdiction as the last challenge. Digital economy allow business. We know that allow business to operate. We say to operate in what we call multiple countries. Basically allow a business to operate in what we call multiple countries without physical presence. Without physical presence. That you can operate in even 5 countries without physical presence. And say this basically, we say that this brings. Where do you take the tax? This brings a challenge of allocating. Challenge brings a challenge of allocating what we call a tax rights. Allocating what we call tax rights, because you can be operating in multiple countries. So where are the tax rights? Which country does it go to? So those are some of the challenges that are basically enforced by the digital economy. In as much as our quest is to have the digital economy, because we know that the digital economy basically increases the tax base. These are some of the challenges that basically emanate from the digital economy. That is how we basically handle what we call the digital taxes. Welcome to Manifested e-learning platform. We are continuing with our series, that is a block revision, December 2024. And today we are tackling, that is question 5, Roman C. So the question goes, Tamala Nyambura is a resident of Kenya. Full stop. During the year ended 31st December 2023, she received the following income. Number 1, from employment income in Kenya, shilling 720,000. The figure is gross. Then you have from employment in Zambia, shillings 540. And we're being told that net of, we're being given a figure net of 78,000 paid as tax in Zambia. Assumes that Kenya has a double taxation agreement with Zambia. Income from Zambia has already been converted into equivalent Kenya shillings. Required, compute the double taxation relief due to Tamala Nyambura and the net tax payable, if any, for the year ended 31st December 2023. And that question is basically 5 marks. So this is basically on taxation across the borders, and this is what we call double taxation relief. For example, when you have a resident that also earns incomes in another country, and precisely for this question, we have a resident called Tamala Nyambura, who is a resident of Kenya. He earns an income, employment income in Kenya, but at the same time, there's also what we call employment income also in Zambia. So we're being told Tamala Nyambura is a resident of Kenya. During the year ended 31st December 2023, she received the following income. So say that taxable income. So you can say we start on that taxable income in Kenya, taxable income in Kenya, that is in shillings. So the figure for Kenya is 720 gross, 720,000. That is a figure for the taxable income in Kenya. Then we have taxable income, taxable income. We say in Zambia. So look at the figure for the Zambia. Zambia, we're given a net figure of 540, net of 78. So we need to get the gross figure. So getting the gross figure, basically that we're going to have, we have 540,000 plus 78,000. So when you add those two, we get, so that should be 618. Gives us a figure of 618. So total taxable income. We have the total taxable income. We have what we call the total taxable income. If you add the two, we have 720, 618 plus 720. That should be 1,338,000. 1,338,000 as the figure. Tax on the total income. We get the tax on what we call the total income. Tax on the total income. So basically tax on the total income, that is income both and in Kenya and Zambia. We'll look at the tax table. That is a tax table is normally indicated on the first page of any taxation paper. And particularly this was for 2024 December. Remember, these figures are annual. So on the tax table, we have monthly and we have the annual. What we do, because the incomes are basically annual. So we pick the figures for annual. So we're being told that the first 288, that is on annual. The first 288 on annual, we tax at 10%. So 288 times 10%, this is the figure that we get, 288. The first 288, then times 10%, that is 0.1. That should give us a figure of 28,800. So then we're being told on the tax table, we're told that between 288.01 to 388, we tax at 25%. So the difference should be basically 100,000. The difference should basically be 100,000. So that 100,000 we basically tax at 25%. So 25% of 100,000, that should be 25,000. So what is the total taxable income in question? The total taxable income in question is 1,338,000. So we're being told that excess of 388 to 6 million, we tax at 30%. What is our total taxable income? That is 1,338,000. We less 388. We less the 388,000. Then we multiply by 30%. We multiply by 30%. We multiply by 30%. So the figure is, when you get that, we have 1,338,000. So we less 388. So when you less that, we get a figure of 950, then times 30%. So we have a figure of 285. That gives us a figure of 285. So with 285, now we get what we call the gross tax. So the gross tax, we had 285. we add the 285 plus 25 plus 25 plus 28,800. 28,800, we get a figure of 338,800. That is a gross tax. But that gross tax is essentially for the two incomes. That is the income that is basically earned in Kenya and the income that is earned outside Kenya. So we get the taxation for the income in Kenya. Tax for income, this is the gross tax. We call it tax for income. Income, we have it earned in Kenya. Tax basically for the income earned in Kenya. So for the tax for the income that is essentially earned in Kenya, we know that that income that is earned in Kenya, for the income that is earned in Kenya, for the income that is earned in Kenya, for the income that is earned in Kenya, that income is basically 720. So 720, that is also an annual income. 720, that is also an annual income. So we know that the first 288, we tax at 10%. That gives us a figure of 28,800. That gives us a figure of 28,800. Then you're being told that between 288 to 388, that should be 25%. So that difference should be 100,000. So 100,000 we multiply by 25%. That should be 25,000. That should basically be a figure of 25,000. So between 388 to 6 million, our total income is that figure. We have 720 minus what we have as 388. Then we multiply by 30%. So what do we get when you have that? We have 720 minus 388. So that should be 322 times 0.3 times 0.3. So that should be 99,600. So then we have what we call the gross tax. We have the figure for the gross tax. So for the gross tax, we have 99 plus 25 plus 28,800. So we basically have a figure of 153,400. The figure is basically 153,400. We have a figure of 153,400. So we want to get the gross income expected tax in Zambia. Expected, what we call the expected tax in Zambia. Expected tax in Zambia. So expected tax in Zambia. We could as well less the relief, or remember that the relief we can less relief here and less relief here, but at the same time we can decide just to get the gross figure, and as we get the double taxation relief, that relief will less the relief there. So we have expected gross, expected total, expected, that is a total gross tax, total gross tax. We had a figure of 338,800. Total is 338, that is for the total income. 338,800. Then tax on income in Kenya. Tax on income in Kenya. So tax on the income in Kenya, we have 153. So expected gross tax, expected gross tax on income in Kenya, on income in Zambia. Expected gross tax on income, expected gross tax in Zambia. Expected gross tax in Zambia on income on income in Zambia. Why do you say gross? Because we have not less what you call the personal relief. So when you less the two, we have 800, 400. So the figure is 185, 400. So this is the expected gross tax without lessing the personal, without what you call the personal relief, without the personal relief, expected gross tax. Then so tax paid, Zambia. The tax that is paid in Zambia, into bracket, the net of 78,000. So we have the two. So when you payable, tax payable, we look at tax payable. We are told that double taxation relief due to Tamala and the net tax payable. So we have the gross tax payable, we have net tax payable, we have the gross tax payable. So the gross tax payable on our first figure, that was 338,800. We have 338,800. Then we less what we call the tax credits. We less what we call the tax credits. So one of the tax credit is what we call personal relief. So personal relief, we have it as a figure of 28,800. We less that, entitled to all resident. That is a personal relief. Then you have what we call the double taxation relief. Relief. Again, when you look at the double taxation relief, we were to compare the expected tax. That was 185, 400. We compare with 78. So we pick the lower. The lower is what is granted as a relief, that is 78. So when you less those two, we get what we call the net tax payable. We get what we call the net tax payable. In that, how we essentially handle a question on double